All right. Today is Monday, September 20th, the day where legends were born, aka it's my birthday. And perhaps that explains the action that we saw in the market today. Because Papa Jerome called me and he said, "What do you want for your birthday?" And I said, "A market crash. That would be nice." And Papa Jerome said, "Okay, he's going to grant my wishes. He's going to stop the printing machine on the day of September 20th. And then the next day, we go back to what we were doing before. Print, baby, print. But let's talk about this market because, yes, I am anticipating a rebound tomorrow, but I don't think that the pain is over yet. I think the pain will intensify in the next few days and next few weeks. But here's the issue that market experts and commentator pinned the correction in the market today on the Evergrande crisis over China. We talked about Evergrande in this channel a few days ago, and I said that the risk could be a contagion effect. And perhaps we saw some of that today, but we have to be clear regarding the risk here when it comes to Evergrande. Because we have calls all over the place saying that this is China's Lehman moment, and perhaps this is the beginning of the global financial crisis that will start with Evergrande and continue to spill over the global economy. I disagree with all of that. We have to put the risk in perspective, and therefore, even though I wanted to make this program limited to the technical analysis, I have to revisit the fundamentals once again and make the program longer. So just when I thought I'm out, they pull me back in. And here it is, folks. In focus tonight, we're going to talk about the wall of worry. Once again, market commentators pinned the drop in the stock market today on Evergrande. I disagree with that assessment. I think that it was a combination of all of the items in the wall of worry that we discussed last night, among them China and the Evergrande issue. So let's talk about that. The market opened down 500 points in the morning, the Dow Jones that is. And of course, the sell-off intensified all the way till the end of the day. And at some point, the Dow Jones was down almost 1,000 points. And by the way, we have discussed this exact scenario that one day you're going to wake up in the morning, something happened over at China regarding Evergrande, and you will see the Dow Jones down 1,000 points in the morning. And of course, overnight, the Hong Kong market, the Hang Seng, was hanging by a noose. It was down over 3.5%, the Hong Kong market. Although Asian markets were closed in general due to a holiday, but Asian markets will open tomorrow, and it will be interesting to see the reaction of Asian markets, specifically after the last-minute rebound in U.S. markets. Will Asian markets open up higher, or will we see another gap down? When we talk about Evergrande, the crisis did not begin today. It has been going on for months and months, perhaps years and years. But now, the sum of all fears from the wall of worry is heading at the same time. Evergrande is the largest real estate firm in China, and they have liabilities of over $300 billion. And the risk is the company will default since it cannot pay its obligations, and somebody from this crisis will end up holding a massive bag worth $300 billion. And this is exactly where the risk relies. Who will end up holding the bag? Because if Evergrande collapses and we have investors and creditors, meaning the banks, end up holding the bag, then we got a problem here. And this will be indeed a ripple effect in the market, in the Chinese market, but not just limited to the Chinese market. Now, my hunch is the Chinese government will not allow this to happen, even though we have calls all over the place saying that this will be a domino effect in the global economy and global markets. I get that, but the Chinese government has a point to make. They want to show the world, but specifically their own population, that the capitalist experiment in China that has been going on for decades now, this experiment is flawed, and if China continues on that path, the path of capitalism, China will end up like the United States of America, with an economic system closer to crony capitalism, aka gangsterism, where investors are taken advantage of, and we have firms that are too big to fail, and we have a massive wealth gap between the rich and the poor. And the solution for all of that is going back to the roots of communism. So a little bit of pain, a little bit of chaos will make that point for the Chinese Communist Party. But at the end of the day, if the Chinese government end up holding the bag, meaning bailing out Evergrande or bailing out the banks, the lenders for Evergrande, and perhaps nationalizing the company, taking over the company, this will be the best case scenario. The worst case scenario, if the banks end up holding the bags. But if the government end up holding the bag, it's still bad because it will slow down the Chinese economy. This is a massive bag worth over $300 billion. In any case, this is not a good outcome, but the best case scenario is the Chinese government holding the bag. And the response could happen as soon as tomorrow morning. You wake up in the morning, the Chinese government announcing something, and we see Asian markets popping higher and Wall Street following through. Rebound day. Look no further than the recent crackdown over Macau against casinos. The Chinese government creating a crisis, pushing all of these stocks down. Everybody's talking about it now. And then here comes the solution. Here comes the remedy, and Chinese officials will sit down with casino operators and they will work out a deal in which the deal will favor the CCP. Whatever regulations, whatever taxations, whatever oversight the CCP wants over the casino industry, it will be granted. Likewise, when it comes to the Evergrande crisis, now that this is spilling over the Chinese economy, Asian markets, global markets, the Chinese government will come over, work out a deal where they get what they really want, taking the country back to the communist roots. So again, I don't believe that this is a Lehman Brothers moment where global financial markets will crash due to Evergrande. I think the Chinese government will interfere and they will work up a deal favorable to them. But we have more concerns now about the next shoe to drop, perhaps over at the United Kingdom, because inflation is raging across the globe. And you might have heard the numbers, the PPI numbers over at Germany, the highest number in decades, the Producer Price Index. And now we have calls over at the United Kingdom, a crisis in the poultry industry due to the shortage of carbon dioxide, which is used to euthanize, aka kill chickens before getting processed. Now, I grew up with goats and chickens, and they're extremely intelligent animals. You have no problem eating chicken wings, but when you spend time with your chickens, you grow an attachment toward them. And when somebody says, it's time to get your chicken to make a meal, you gotta say goodbye, all of a sudden your inner John Wick comes out. And of course, someday I will be a vegetarian. Someday it will happen. We have a crisis here over the United Kingdom due to the rise in energy prices in general. Now, they can use other methods of euthanizing chickens, perhaps old school slaughtering with a sharp knife, but this will take time and it will take more effort. What does that mean? Prices of chicken will rise higher in the United Kingdom. But this crisis is due to the rise of energy prices globally. And now we have British energy firms at the risk of collapse due to the inflation in energy prices. So perhaps this will be the next shoe to drop. When inflation is rising out of control, is the Federal Reserve listening? Is the ECB listening? Is the Bank of England listening? Of course not. What else? On the wall of worry, we have the debacles of the Biden administration. So once again, it's not just Evergrande. It's everything coming out at the same time, along with seasonality, along with the technicals, along with the sentiment, etc., etc., etc. When we talk about the Biden administration, just yesterday, UK Prime Minister Johnson, not the guy from down under, by the way, just Boris, no biggie, no Prime Minister. Just Boris and the other guy from down under. But the British were angry against the Biden administration due to the restrictions of Britons visiting the United States. And now we have an order. The restrictions have been lifted. And now we have European, British, and Chinese citizens allowed to visit the United States once again. Of course, given the fact that they will be fully vaccinated. If you're not fully vaccinated, you're not going to be able to come over here. Unless you're rich, of course. Then the rules don't apply. Just like we saw in the Emmys last night and other Hollywood events, where masking rules don't apply for the rich, the celebrities, but they apply for their handlers and the staff at the events. Two-tier society. But the real problem here when it comes to the Biden administration in the wall of worry as a concern economically speaking is the crisis with France. The French are livid because we cost them billions and billions of dollars from stealing the deal for the submarines with Australia. And even this crisis is deepening too. Now we have North Korea, Kim Jong-un. He's not happy with the deal at all. And Kim Jong-un is warning of countermeasures. And now we have Kim Jong-un's sister warning of destruction of South Korean ties following the missile tests. And of course, Kim Jong-un is resuming testing for ballistic missiles once again. Now, we know that Kim Jong-un and North Korea have been testing missiles for a long time. This is not new at all. But the risk is what happens if there is an accident. What about the debt crisis here in the United States, the debt ceiling, which is also another source of worry, another source of risk to the market? Well, now we have the Biden administration proposing a $1 trillion mint in the form of a platinum coin. And of course, the Republicans, McConnell, are not thrilled with this idea, but it looks like the Biden administration will sidestep McConnell and the Republicans to pay for, quote-unquote, our bills. Likewise, today we got the news. Democrats tying the suspension of the debt ceiling to the spending bill worth trillions and trillions of dollars. And of course, the Republicans, McConnell, already responded saying that we're not going to do any deal suspending the debt limit. So here we go again. We have a standoff between Democrats and Republicans, the blue cult and the red cult. And we're living in this fantasy world, assuming that the happy ending will happen all the time in this Teflon market. For example, China will rescue and bail out Evergrande. Likewise, don't worry about tapering. The Fed, Papa Jerome, will come out on Wednesday and announce that he will not taper. And when it comes to the debt ceiling, don't worry about it. This is the circus between the Democrats and Republicans. It happens all the time, but the government will not shut down. And at the end of the day, the debt ceiling will be suspended. Again, how do you guarantee that? You cannot guarantee anything. But we have this hyper bullish sentiment in the market where everything is going to be all right. You don't have anything to worry about at all. But if we learned something from this pandemic, is expect the unexpected. Always play the devil's advocate. What if? What if it happens? This is the risk that you have to calculate in your investment strategy. And in your trading strategy, by the way, the assumption that everything is going to be fine, this hyper bullish sentiment is extremely dangerous. And the pump we got at the end of the day in the stock market today is yet another illustration of this hyper bullish sentiment. Nothing is going to stop the market. Dips will be bought. The Fed has our back. China will be fine, Korea will be fine, the French will be fine, the Biden administration will be fine, the economy will be fine. At some point, this becomes irrational delusion. When you have the wall of worry stacked up to the max, we get days like we got today. Ugly, nasty, and in my opinion, we will get more of those until and unless this hyper bullish sentiment is washed out of the market. What did you hear today all day long on CNBC, Bloomberg, and the likes? Buy the dip. This is a great buying opportunity. The market will rebound. Jerome Powell will speak on Wednesday, and he will save the market. Yada, yada, yada. When everybody's thinking that this is a dip worthy of buying because the Fed will bail us out again, the likelihood is the opposite will happen. And that leads us to the other risk of margin calls. And this comes hand in hand with margin calls, by the way. The forced deleveraging when volatility indices rise higher. Meaning the VIX spikes up higher above a certain level, and now we have forced selling, autopilot selling to the tune of $40 billion. This is yet another risk if the VIX continues to rise higher and higher and higher. Now, while my reading is the correction is not over, until and unless the hyper bullish sentiment is washed out of the market, we might get a rebound, a nice one, starting tomorrow. Why? Number one, the hyper bullish sentiment of buying the dip and the expectations that Jerome Powell will save us. Likewise, you have bears who shorted the market, covering their shorts, including myself, by the way. Why? Because the bears are scared. The bears are traumatized. Every time they short the market bounces higher. And you saw a lot of short covering by the end of the day. Why? Part of it is the trauma among bears, but most importantly, the anticipation that perhaps Powell will save the market. I disagree with that sentiment, but I agree that we should have a bounce tomorrow. Besides the expectations of a Powell save, we have the technicals. Severely oversold, and I will show you the advance to decline ratios in a minute, and I will show you the charts. But we also have the likes of Jim Cramer coming out today saying that perhaps you have to sell stocks and not buy the dip due to the volatility and the seasonality of September. He's right, but there is a rule in the market that says when Jim Cramer says buy, you sell. When Jim Cramer says sell, you buy. So this has been an accurate contrarian indicator for years and years and years. So what did I do today? I closed my SPY puts that I bought last week. And of course, I closed them at the beginning of the day. That means I left a lot of money on the table because these 440 puts on the SPY at the height of the day were trading at around 12 to 13 bucks a piece. I closed them at around 7. And the reason is I had to take phone calls from work and I did not have time for personal trading. Why? Because we have clients bitching and moaning all of a sudden, wanting to hedge. Now you want to hedge? Last month, in August, and I announced this on Twitter for you guys that I'm selling 70% of my portfolio, getting rid of 70% of my long portfolio, and raising cash in anticipation of the upcoming correction in the market. You gotta be proactive, not reactive in such market, because if you want to hedge right now, when the VIX spikes above 20, as we've seen today, the premiums on put options increase dramatically, and now you have missed your chance to hedge. But this is yet another indicator that perhaps we're getting closer for a bounce here, at least a momentary bounce in the morning tomorrow before we sell the rip once again, because the sentiment becoming extremely scared, extremely worrisome. Back in August it was, I don't need to hedge, the dips are being bought, the Fed remains accommodative, you're just too concerned. Now it's becoming, I'm shedding my pants, please hedge my portfolio. So you have to keep the sentiment in mind here. My expectations are a bounce tomorrow, perhaps for an hour or two in the morning, and then we see sell the rip once again. And therefore, I bought calls on Freeport-McMoRan, a stock that I own in my portfolio. And the reason is the dollar did not spike up higher today. We did not have a confirmation from the dollar. We did not have a confirmation from yields spiking up or down. And therefore, I believe that we have a rebound imminent in the market, absent of more surprises in the morning from China. And therefore, I bought puts on the UVXY, the VIX, and we will see how they do tomorrow. My strategy is, my expectations, I should say, a pop in the morning. I will use that opportunity to close the calls on FCX, perhaps close the puts on the UVXY, and go back to buying puts on the SPY, perhaps the Qs, because I do not believe that Powell will please the market this time around. Here is the last item for discussion today in the wall of worry, tapering. We talked about the printing machine being jammed today, but the consensus among market participants and market observers alike is that Powell will come out on Wednesday announcing no taper, and the market will rejoice, we will see a bottom, and the market will rally once again. I doubt that this will happen because we have inflation raging out of control. On top of that, we have the lowest unemployment numbers from weekly perspective, the weekly claims, since the pandemic started. So if Powell want to talk about substantial further progress, we're now beyond substantial further progress when it comes to inflation, and perhaps also when it comes to employment, because the virus is the one in charge when it comes to employment in this economy, not the monetary policy. And here we have ex-New York Fed President Dudley, and he came out and said today that concerns over China's real estate sector rattling stocks won't deter the U.S. Central Bank from signaling it is on track to scale back assets purchasing. So be careful here of what your assumptions are, that the Fed will remain accommodative forever because we have a little shakedown in the market. Remember this, Wall Street is now bitching and moaning to Jerome Powell and the Fed about the labor shortage and the problem with wage inflation. And I told you, they will tolerate inflation in the stock market. They will tolerate inflation in the real estate market. But one thing they will not tolerate at all is the rise in wages. God forbid your wages go higher. We're going to end the show right now, Mr. Powell. Taper right now. And if you're keeping your eyes open and you're watching insider trades, insider selling, well, we know Fed presidents, Kaplan and the likes, dumped right at the top. Nice timing. And now we have Tim Apple also dumping at the top. And if you're watching the Waltons, Google executives, Zuckerberg, all of the big shots are dumping stocks like never before. They're already cashing in and they're ready for the flush down. Make those stocks cheaper, Mr. Powell, so we can use the cash, buy the dip, and become even richer while we wash out retail investors and traders and leave them holding the bag. Anyhow, folks, we gotta move on here. We got a market to cover. And here we go. The Dow Industrial Average closing in the red, down 614.41 points, or a decline of 1.78%. The Nasdaq down 330.06 points, or a decline of 2.19%. The S&P 500 down 75.26 points, or a decline of 1.70%. And notice the volume spiking higher, which is yet another indicator that perhaps we have a short-term bottom. What about the relative performance of different sectors of the market today? Leading the pack at number one. Whoops. Not capturing any metals at all. Why? Because every sector of the market closing in the red today. A bloodbath across every single sector of the market. And the pain was led by consumer cyclicals, energy, and materials. What about the advance to decline ratios? The NYSE only 5%. 5% advancing versus 93% declining. What about the Nasdaq? 10% advancing versus 88% declining. What does that mean? Extreme sell-off in the market, which means a short-term bottom. When you see exaggerated numbers like this, it is usually an indicator that we will see a bounce at least in the morning tomorrow, absent of another surprise overseas from China. Moving on to futures, what's going on here? A bloodbath, but it remained contained. And the reason is the dollar did not spike up higher. Pay attention here. If the dollar spiked up higher, then we have a confirmation of the weakness in the market today. We did not have that. Perhaps this will happen after Wednesday. But for now, we don't have a confirmation. And therefore, the likelihood is if the dollar continues to weaken ahead of the FOMC meeting, then we will see a rebound in commodities, specifically metals. But here's a review of the action that we got today. Crude oil prices were down slightly. The WTI was down about 1.5%. We have nat gas down about 3% or so. The pullback in nat gas continues, but as I've told you before, the rebound will happen, and we haven't seen the end of the gains, the end of the rally in natural gas. What about grains? Pain across the board, led by soybean oil, oats, soybean, canola, wheat, corn, soybean meal, rough rice, all of these closing on the downside today. What about meats? We have slim gains for feeder cattle futures. Meanwhile, live cattle futures closing on the flat line. On the other hand, lean hogs suffering a decline of about 1% today. What about metals? Gold with a slight rebound today of about 0.75%, but we have pain in palladium down almost 6% today. Likewise, platinum is down over 3% and copper down almost 3% today. We have minimal losses here for silver futures, down about 0.5% today. What about softs? Pain across the board. We have lumber down, cotton down, cocoa down, coffee down, sugar down, OJ down. Everything is down. But like I said, if the dollar weakens tomorrow, we will see a rebound in commodities across the board. Now, I want to bring to your attention this issue regarding palm oil. We don't cover palm oil futures usually in this show, but prices have been skyrocketing higher. And the reason is the shortage in supply due to COVID impacts. And this is coming hand in hand with a moratorium against new plantations of palm oil in the country of Indonesia. Of course, to start new palm oil plantations, you have to do some deforestation first, because the country is full of forests. Palm trees are native to Africa, but they're chopping down the forest to plant new palm oil plantations. And now this moratorium is expiring, meaning palm oil futures are likely to go down, and we will resume planting new palm oil plantations and destroying the environment. This is perhaps the greatest ecological risk on the planet right now, the deforestation going on in Indonesia. And you can see the pictures on your own. Forests being burned down to make way for new palm oil plantations. As far as the eye can see, and you can use Google Earth, by the way, and zoom in the island of Sumatra, for example, or whatever island you want to use in Indonesia, and you will see at least half of the island has been already deforested. And you see these massive palm oil plantations. You keep scrolling and scrolling and scrolling, and they keep going and going and going. This will cause a massive devastation in the ecosystem in the country, in the future of the environment and wildlife, because the country of Indonesia is extremely rich with wildlife. We have animals that survived thousands of years, moving from Africa to India all the way down to Southeast Asian islands, including elephants, rhinos, the orangutan, tigers. All of these animals moved and survived thousands of years to exist in that particular island. And now all of these species at the brink of extinction due to palm oil plantations. On top of that, we have the EV industry, mining for lithium, but specifically nickel, over in Indonesia to make batteries for these vehicles. And do your own research. The mining of nickel, lithium, cobalt is extremely destructive to the environment and will be a double whammy against the environment and wildlife in Indonesia. The level of pollution is absolutely stunning from nickel mining. And now we have the likes of Tesla, Japanese automakers, but specifically Chinese automakers mining for nickel like crazy over at Indonesia. And of course, you have these virtue signaling assholes over at Silicon Valley flashing their Teslas as if, hey, I did my part, I'm driving an EV, look at me, I'm saving the environment. Are you really? Or are you exporting the pollution from richer countries, Western countries, European countries, and the United States over at poorer countries, the likes of Bolivia, Indonesia, and the likes? Would you mine for lithium, cobalt, and nickel? It's another form of environmental colonialism, moving the pollution from richer countries to poorer ones. But hey, so long as you feel guilt-free, you did your part and you can party again, this is all what these assholes care about. Their woke token, but are they really aware of the facts? And here's one way you can help, by the way, specifically when it comes to palm oil. You can support sustainable palm oil by using this app, and it's not perfect, by the way, but it works. You can use it to scan items by typing the name or scanning barcodes, and it will show you whether the sources of palm oil in this product are sustainable or not. And this is just a small step that you can do to address this problem. Moving on to the big casino, the options market. What's going on here? When we have a massive down day, market participants are usually shy with options trading because you have no idea where the market is going to go next. And of course, options premiums move up higher as the VIX moves higher. But here it is at number one, the hottest table in the casino is Apple with 1.3 million contracts. About 61% of those were calls. At number two, Tesla with about 730,000 contracts. About 44.5% of those were calls. And number three, AMC with about 550,000 contracts. About 60% of those were calls. What about the unusual activities that took place in the options market today? Again, not significant action at all. The trades mostly are few cents here and there, traders betting for massive moves, wild shots, as I showed you in my own trades, in FCX and the UVXY. Out of the money calls, out of the money puts, wild shots. If we see a rebound in the market tomorrow, they will appreciate handsomely. You dump them right away. And we're seeing more and more of this strategy going on in the market as we see traders betting up or down impulsive moves out of the money with smaller premiums. Let's start with the ticker BE for Bloom Energy. They're buying the 16 puts for the expiration date of October 15th, with expectations that the name will drop by more than 14% by then. They paid about 30 cents apiece to enter this trade, all in all spending about $1 million. What about the trade for the ticker VST, Vesta? They're making an upside bet here by buying the 18 calls for the expiration date of November 19th, with expectations that the name will pop higher by more than 5% by then. They paid about 75 cents apiece to enter this trade, all in all spending about $1.5 million. What about the trade for the ticker TLT? They're buying calls here, interesting, betting that the Fed will not taper and perhaps will increase their bond purchasing program. There are a lot of market experts and YouTubers thinking that this is what will happen. The Fed will actually increase quantitative easing, not decreasing it. And therefore, they're buying calls on the TLT, the 159, with the expiration date of November 19th, with expectations that the name will pop higher by more than 5% by then. They paid about $1 a piece to enter this trade. All in all, spending about $1.8 million. What about the trade for the ticker EWZ? This is the Brazilian ETF, an economy that is highly dependent on commodities. And perhaps the bet here that we will see the dollar spiking higher, more pain in commodities, and therefore they're buying puts on the EWZ. Specifically, the $30 puts with the expiration date of November 19th. With expectations, the name will drop by more than 7% by then. They paid about $1.30 apiece to enter this trade. All in all, spending about $1 million. What about the trade for the ticker GME, GameStop? And by the way, notice that today, it's not just stocks are down, but we have meme stocks down too, along with cryptos. What does that mean? This time, it is different. You might buy the dip tomorrow for a few days, few hours perhaps, but the market will resume selling once again because this is the shift in sentiment from hyper bullish to become bearish, maybe a cub bear, not a full grown yet, but that could happen too if the sell-off intensifies. But for now, they're buying puts on GME, the 170 puts with the expiration date of this upcoming Friday, September 24th, with the expectations that GME will drop by more than 11% by then. They paid about $1.50 apiece to enter this trade, all in all spending about $1.2 million. Lastly, what about the trade for the ticker XOP, the oil ETF? They're betting for a rebound here by buying the 89 calls with the expiration date of November 19th, with expectations that the name will pop higher by more than 6% by then. They paid about $4.20 apiece to enter this trade. All in all, spending about $3.3 million. Moving on to the heat map analysis. What's going on here? A bloodbath across the board. Nothing to see at all. Everything is down, with very few exceptions. For example, we have airline stocks bucking the trend and moving higher, Why? Because of the news we discussed earlier in the show, allowing British, European, and Chinese citizens to fly back into the US unless you are unvaccinated. Likewise, it was an upside day for vaccine and therapeutic makers regarding COVID-19, the likes of Pfizer, AstraZeneca, and Eli Lilly, all moving higher. We also have Lucid Motor moving higher, and it has been on an uptrend, moving higher, popping higher, due to mechanical reasons regarding SPACs. The redemptions are happening, therefore more buying of the stock due to redemption. We talked about Lucid, the move in Lucid before it happened, and it continues to happen with no stop in sight until the redemptions are over. But all in all, an ugly day, a nasty day, as Jim Cramer would say, a bloodbath across the market. Even defensives like gold, utilities, REITs failed to impress today. Some outperformance, but not by much. That tells you the sell-off was indiscriminate today. Let's move on to charts, starting with SPY, 30 minutes chart. What's going on here? A massive flush down in the morning, a massive gap down. Where did the chart stop? 434. By the way, it did not draw these lines today. The line's been here all along. Matter of fact, this is what my daily SPY chart looks like. I leave all lines and annotations attached. It's a mess. But anyhow, back to the 30 minutes chart. What's going on here? Gapping down. 434, it holds on for a little while, but it became clearer in the morning that 434 would not hold, and we will see more pain to come. And the chart flushed down the moment 434 was broken. Right away, the flush down all the way to 430, 430 and a half. You can go 430 again. It's a zone. It's not an exact number. And at that point, at 430, not the time, but the level. When you look at the RSI from a 30 minutes perspective, we have reached extreme oversold conditions, prompting a bounce. And right away, we've seen the massive bounce, the short covering bounce at the end of the day. The likelihood is the bounce should continue, at least overnight in the futures. But the pain is not over yet because we have broken technical patterns and technical trends that have been going on for months and months and months. My assumption is the chart will attempt to climb all the way back to 438, perhaps all the way to closing the gap. And if that happens, everybody will jerk off, the biggest orgasm in Wall Street history. But hold your horses, because we will not have any clarity whatsoever until the aftermath of the FOMC meeting, specifically the conference from Chairman Jerome Powell. What about the daily chart for the continuous contract on the SPY? The trend has been broken. It's over. It's done. And the chart traded below 4,384.5. Now, in typical shorting behavior. The is this? Anyhow, in typical shorting behavior, when a chart is broken, we don't see a flush down in a straight line right away. You still have that sense of resiliency, the leftover hope, and the chart attempts, keyword attempts, to climb the trend line higher. But we do have a confirmation of the break because it is not just breaking the trend, but the chart broke in the support line of 4,384.5. We have a confirmation from the momentum indicators, the MACD and the RSI, and therefore the likelihood is the trend is over, regardless of the rebound that we're about to get, which is most likely a reflex of a dead animal. The trend is over. It's dead. But we will see the reflex and then the confirmation that the trend is over by another flush down. For now, we will take it one day at a time. What about the Qs? 30 minutes chart. What's going on here? A flush down, no surprise. And again, we have reached extreme oversold conditions on the RSI from a 30 minutes perspective. What does that mean? A massive rebound higher. I would have loved, to be honest with you, I would have loved if the market closed at the lows of the day and then we open up trading higher. But this last minute rebound is a little fishy because the expectations are we're oversold, we're due for a rebound. But what if the rebound already happened during the last hour of the day? Then we're not going to have a rebound tomorrow because the rebound already happened. We'll see. But the RSI, the MACD indicator from an intraday perspective remain extremely oversold. The chart flushed down to the support of 365.5. It was a battle for a couple of hours. The bears won. The chart went down to the next support of 363. It was a battle for a few hours. The bears won again, and the chart went down to 360.5. You can round that up to 361. Doesn't matter to me. It's a zone. And finally, the bears took profits, pushing the market higher. Now, the media, CNBC and the likes, were describing the action during the last hour of the day as dip buying. The optimism is still here. It wasn't dip buying. It was bears, shorts covering, taking profits off the table. Why? Because we have this programmed expectations that the Fed will always be accommodative. And heading into the FOMC meeting with a short position is a recipe for suicide. I'm not against the sentiment. I'm not against the short covering at the end because I did it too. I'm not going to hold the short position, specifically put options, when we have the technicals oversold, the advance to decline ratio extremely exaggerated to the downside. Oh, and by the way, we have an FOMC minutes in the next couple of days. It makes sense to cover your shorts by the end of the day and then short again once the rebound is over, and perhaps once we have a confirmation that Powell will indeed taper. The support for now at 365.5. Meanwhile, the resistance at 369. We will see what happens as soon as the chart reaches 369. What about the daily chart for the continuous contract in the Nasdaq? We have a flush down. We had a semi-bull flag formation from a candlestick pattern, but I warned you over and over and over again. Be careful of making trading decisions based on candlestick patterns. A lot of amateur traders pick up a book or an online course, and they look at these patterns, bull flag, bear flag, doji, ninja, whatever the hell it is, and they trade based upon the patterns. But you gotta combine the patterns with the momentum indicators, with the volume, with the fundamentals, with the psychology, with the seasonality, and then you have a greater picture, a greater assessment whether to go ahead and follow the candlestick patterns or go against them. In this case, we went against them because the momentum indicators were weakening. The volume was climbing higher. On down days, the seasonality was bad. The fundamentals were getting bad. And therefore, we have a flush down, a massive one. And now the chart has breached 15,000 as support. However, it managed to close above that level at the end of the day. Will the bounce hold or not? It depends. As I said, did we already get the bounce? If the answer is yes, we've already worked out the oversold conditions, we got the bounce, and we have more bad news in the morning from China, then the flush down continues. But if this was the beginning of the bounce, the action that we saw at the end of the day, and we will continue to work out the oversold technical conditions, and oh, by the way, the bears will continue to take profits by short covering ahead of the FOMC minutes. On top of that, perhaps a resolution from China, a government intervention regarding the Evergrande crisis. If all of these things take place, then the market will rebound tomorrow. Absent of that, the pain will continue. And the pain will continue either way, by the way, in my opinion. But we will have rebounds, sharp ones, along the way. Here is a daily chart for the NDX. We're tracking the correction back to the trend line, which should take us about 8 to 9%, let's say 10%, all the way down to the trend line from the top. We're getting closer here, but we're leaving a massive gap, and the likelihood is it will be a battle. You're not going to have a straight line, a flush down all the way to the trend line. You're going to have a battlefield between bulls and bears, massive rebounds, back and forth, back and forth. What about the IWM, the Russell 2000, small caps from a 30 minutes perspective? Breaking the support of 218 in the morning, it tried over and over and over again to reclimb 218 and reclaim that for support. But again, the attempt was met with failure, and the IWM went down all the way to the lows of the day around 214, not quite to the support line that I have, 212, and rebounded higher, which by the way coincides with the previous gap, as you can see in the yellow bubble. The assumption is, if the rebound continues in the morning, the IWM will be able to reclaim 218 for support. Will it go all the way to close the gap? Did it lift in the morning? Perhaps not. I believe that we will see a rebound in the morning and then sell the rep once again, yet not as intense as we've seen today. Why? Because we have the FOMC minutes coming up. But perhaps this is the most important chart of the day, of the week, of the month, of the year, the dollar index. You would think on a down day, a massive down day, we will see the dollar index spiking up higher. It did not happen. Now, the momentum indicators remain positive, indicating that there is a pop imminent in the Dixie. It didn't happen today, and therefore my assumption is perhaps the Dixie will go down, retest 93 as support, and then bounce higher after the FOMC minutes are out. Gold, what's going on here? A rebound day for gold, reclaiming the Fibonacci support for around 1,760, but again, I don't believe that this will be a solid support at all. Matter of fact, I believe that gold will go down. all the way to the next support of 1,685 because it looks, at least for now, that the dollar is about to pop higher. It might have a down day tomorrow, but boy, it will be hard for Powell to bullshit this time around about substantial further progress. What excuse will Powell use to delay tapering once again? Moving on to yields, what's going on here? Zigzagging back and forth, but still above 1.28%, holding the line. No update at all. Yields will go up and down, but the ultimate move will happen after Wednesday. Perhaps it will be a violent move one way or the other. Here's a chart of the TLT weekly chart. What's going on here? Popping higher, comfortably above 149, but the week is still young. The real move will happen after Wednesday. My assumption is if the Fed announces tapering, yields will spike up higher, TLT will go down. What about the VIX 4 hours chart? Once again, popping higher. We talked about the MACD indicator, that the pop is not over yet, the pop from Friday. But now, when you look at the MACD indicator, when you look at the last candle of the day, going back to the support of 25. Now, the good news is for bears that the VIX is trading above 20. The bad news is every time the VIX traded at these elevated levels, from an RSI perspective or a MACD perspective for that matter, we have seen a pullback in the VIX. And a pullback in the VIX will come hand in hand with a rebound in the SPY. We have a massive gap here. The VIX can go all the way down, closing the gap at around 21 and then rebounding higher. What about the big kahuna, Apple, weekly chart? What's going on here? My target is going down all the way to the lower end of the channel, which will translate into about 14 to 15% correction from the top. Now, we have a gap open. This is a weekly chart, by the way. And the assumption is that Apple will rebound higher to close the gap, but the pain will resume. We will see a flush down all the way to the target of about 15% correction from the top in Apple, which will be, by the way, a steep correction for the market in general, because as Apple goes, so will the market. Why do I say that, by the way? Look at the MACD indicator, the momentum indicator from a weekly perspective. We have clear weakening here. We have a loss of momentum. As the MACD crosses the line, the average, creating red impressions on the histogram. Now, the week is still young. Apple could bounce higher and do some repair work on the MACD indicator from a weekly perspective. But what is the catalyst here? What is the catalyst that this is the bottom and Apple will rebound higher and make all-time highs from this point on? What is the catalyst? The Apple event is already behind us. There is no positive catalyst here to push Apple higher, beside the technicals, the mechanics of oversold conditions from an intraday perspective, meaning that the rebound and the pop will be transitory if it happens. Here's a chart for Tesla, 30 minutes chart, also gapping lower, no surprise. It will be outrageous if Tesla gapped higher. Whoever's manipulating Tesla's stock via options, had the stock gapped higher, would have been extremely suspicious. But they went down all the way to the support of 720. We don't have any oversold conditions here in Tesla, but the likelihood is, along with the market, we will see a rebound, perhaps 742, see how it does there, but the likelihood is the correction is not over. Whatever rebound, it will be transitory. Whether it rebounds all the way to 742, short of 742, or even exceeding 742, until and unless Mr. Powell says, I'm not going to taper, no tapering at all, you got nothing to worry about, we're not going to taper, go back to the casino, put your blindfold on, and continue to buy. Until then, we're not out of the woods yet. At any pop, any rebound, you have to take it with the assumption that sell the rip will continue. What about BTC, tulips? What's going on here? The bear flag is working, going all the way down almost to 42,000. The lows of the day were 42,500. Again, I don't believe that we have seen the end of the pain here. The likelihood is BTC will breach 42,000 as support, and we will see more pain to come. What's important this time around, it's not just stocks being sold. We have Bitcoin also getting shot, cryptos getting shot, and meme stocks getting shot. This is a significant development in the market. We have not seen this kind of action since the mania started, with very few exceptions. We haven't seen stocks going down, along with memes, along with cryptos. What does that say? We have a massive change in sentiment, from hyper bullish, from being skeptical the correction will happen, buying the dip all the time. And while we've had some corrections, some weakness in the market before, retail traders and investors specifically always found a safe haven in cryptos and memes. This is not happening anymore. And here's the chart of the king of the memes, AMC. The ABC pattern, the reverse ABC pattern continues. A massive leg down, breaching 42.5 as we've expected, by the way. But now look at the RSI, look at the MACD, extreme oversold conditions. The likelihood is we're going to have a rebound, see how it does around 42.5 and take it from there. But here's the daily chart. We already have a confirmation on the weakness as the MACD indicator crosses to the negative territory, creating red impressions on the histogram. What about the weekly chart? Any difference here? Any hope for the apes? Of course not. The MACD indicator is actually showing a rejection when it curls down again without crossing the average. And this is an ominous signal, by the way. And we have seen it over and over and over again in the course of this bubble. Every time the MACD climbs higher, gets rejected, curling down once again, and we see those red columns in the histogram getting longer and longer and longer, this is usually an ominous sign, indicating that the chart will not be able to climb higher. We have already seen the top, we have seen the rebound, the reattempt to make higher highs, and this attempt is done. It has failed, and it will never make it to higher highs. Moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? Nothing major. We have housing permits and housing starts. All important for the housing market, but we know they're not going to move the stock market. They're not going to be market-moving events. What's going to move the market is a resolution, or lack thereof, by the way, out of China regarding Evergrande. The first payment due is tomorrow. Will Evergrande pay its dues? If that happens, the stock will pop higher. We will see a massive recovery in the Asian markets, and Wall Street will follow. If we get another news that the Chinese government is bailing out Evergrande, or will bail out the banks, or whatever resolution that the Chinese government decides, you will see a recovery in shares of Evergrande. Asian markets will pop higher, and Wall Street will follow. Absent of that, if no resolution at all happens overnight, and Evergrande fails to make the payment due, then regardless of the oversold mechanical conditions prompting a rebound day tomorrow, the rebound will not happen. And even if it happens, it will be sold off right away. So once again, the market will move in volatile ways, up and down. Massive down days, massive rebounds, back again down days, but you have to understand the final decision will not happen until and unless the chairman of the Fed speaks on Wednesday afternoon. Until then, this is all I got for you for now, but I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.